Howdy, howdy. It is Ashley and Bill for another mortgage moment. I'm Ashley Tullis. I'm a real estate expert in Dripping Springs in Central Texas. This is my partner in many, Mr. Bill.Roegelein, issuing loans in not only Texas, but several other states. And I was looking at my mortgage statement and I don't understand something. So I want you to give me the lowdown on it. What is PITI? What's the
Pity.
what's this PITI
You know,
business?
that's probably the first time I've heard it called pity. Acronym PITI. So it is a question that comes up a lot. You might actually see it on Zillow sometimes and things of what that payment looks like, but what does it consist of? So real easy is, and I'll just spell them out. P is the principal for the loan, principal amount. The I is the interest that you pay on the loan. The T is the taxes, your property taxes each month. And then the I is the insurance for your homeowner's insurance that you have each month. So from a lending standpoint, that's how we calculate what you qualify for with that estimated mortgage payment. We pile it all in. Sometimes you get confused because sometimes some of these sites might just say estimated mortgage payment, $2,000, and it's just principal and interest. So
You need the T.
you need it all. And even if you waive escrows, which is something random, it doesn't matter. You got to qualify on all those combined together always.
Is there like a standard percentage? And where that question comes from, when I was purchasing my first home, I won't give away my age and tell you how many years ago, but I was listening to Dave Ramsey and he's like, you don't ever want to go over 25% of what you make in your household per month on that. Do y'all use that same calculation?
Are you talking about for the house payment?
Yeah.
Yeah. Well, yeah, so it is. So there's what we call our debt ratios. There's a front end ratio and the back end ratio. The front end ratio is just all of your income compared to this estimated mortgage payment that you have. That's
Okay.
what our front end ratio. That's probably what we're referring to, is don't go over 25% of that, which, you know, you're damned if you do, you're damned if you don't. I don't think there's a really bad spot for it, but everyone can push the envelope bit because that number can go up pretty high to qualify someone, especially if they really want the house. The back end ratio is all of the debts combined, car loans, credit cards, and this potential house payment. So he's right. That 25% is a number, but I can't comment to stay under it.
That's okay.
But
okay.
25 is not a cutoff. You can go higher if you needed.
In my experience, like when I first got my license and I was walking buyers through everything, it was always right towards the end of the transaction. We would say something like, hey, did you get homeowners insurance yet? Now I'm starting to have that conversation earlier per my preferred lender's request. Can you share a little bit about why we're kind of changing our tone on that?
Yes. And there might be some nightmare stories of people missing out on qualification at the end because they've waited to get their homeowner's insurance quote at the end. You know, premiums have gone up. I think we're all not blind to seeing, oh, this year, wait, my payment or my premium just went up 20, 30%, sometimes 40. You know, it's crazy how expensive it's gotten. Just talking to, you know, some insurance referrals that I have, it's just costs more to write these policies for individuals. And with supplies and inflation and things like that, it's more expensive. So people that with their debt ratios that are really tight, we need to know what that insurance quote is up front. So if you're looking at a house and you really like it and you're going to make an offer, I'd highly suggest you go to your insurance agent. I've got referrals. I'm sure, Ashley, you've got referrals to talk to, get some quotes, but see what that insurance payment is, because you might be surprised of what it might be charged, because things that come into play for insurance is age of the roof is massive. If you've got an older house, the roof might be 10 years old, that premium starts going up. You might think, oh, I might be paying $125 a month. That might be $200 a month. See, that's where you really need to do your homework up front, because it could push you out of qualification on a particular house.
So a payment, interest, taxes,
principal, interest,
yes. Taxes, insurance. Do y'all calculate anything else in that equation?
Yes, if there's a homeowners association fee, it will go in there. It's not part of your monthly payment that you usually make to your mortgage servicer, but it is a calculation because it is part of the home.
Awesome. Awesome. Well, thank you for the down low on the PITI. I probably won't be calling
PITI.
it that in the future.
I might use it moving forward. That's kind of funny.
And I appreciate you, as always, serving up all the tips and tricks and the behind the scenes info related to mortgages. Guys, click around here on this YouTube channel. We have a plethora of topics. If you have a question, hit one of us up. We'd be happy to discuss it and maybe even make a video about it, because if you're asking the question, I bet a lot of other people are as well. So thanks again,
Agreed.
Bill, and we'll see you next time.
See you next week.